Let's stay with the financials now, speak a little bit more broadly now, and get some reaction with our guest host for this first half hour, Liz Young, SoFi's head of investment strategy. Liz, it's good to see you. Thanks for being here in person.
Wonderful to be here.
As we were saying before the show, it has been a long time, so it's fantastic to see you. So financials, out of the gate, you know, Bank of America and Morgan Stanley today, not quite as strong, but overall, it feels like there has been strength there.
Yeah.
What can we sort of extrapolate out from that?
Well, first of all, financials usually kick off earnings season. They set the tone. Everybody sort of waits with bated breath to see what the CEOs are going to say. And financials do have a really good lens, particularly the big financials, a really good lens into what the consumer is doing. So not only if the consumer is spending, but if the consumer is still borrowing. So what I heard, generally speaking, from them is that absolutely there's still an appetite to spend. It's still happening. However, there are consumers that are doing it on leverage or on credit. And so far, that is perfectly fine because everybody is still employed in a strong labor market and there's been wage growth. We see real wage growth actually coming back, which is also great. But at some point, right, if that credit gets extended, that's when you start to get concerned. But right now, everything sounds like it's still going well. Obviously, the consumer is a huge part of the U.S. economy. There is no such thing as an economic expansion without the consumer. So if they're spending, that's positive, and I think earnings season has been off to a good start with the financials.
But was the bar already kind of set low, especially like, you know, we just heard when you talk about Bank of America, sure, they beat, but they still, it was lower than quarter over quarter from its previous quarter. And was there anything concerning in the financials, in the financial sector for you?
Well, of course, the bar is absolutely still low. The bar is pretty low across the board, and we're expecting negative 7% growth. That's what consensus expectations are for this quarter. So it's not that difficult to leap over a negative 7% number, right? So yes, it's true that the expectations are kind of not impressive, I guess. Concerns in the financials, I think there are a lot of risks that we already know. So obviously we know what happened in March. We saw this sort of mini or medium-sized financial crisis in the regional banks. We know that that still lurks out there, maybe an issue. There are some data points that we got already from CEOs saying that deposit growth was down. Now, that could either be an indication that things are getting weaker, or it's just a rational investor behavior thing where you've got treasuries offering a good yield, you've got money markets offering a good yield, rational investors, rational depositors would take their money and go get the higher yield. So if at some point rates do fall and money markets and treasuries stop offering that kind of rate, people will put their money back in deposits, right? So this could just be kind of a transient move of money away from deposits that are not offering a good yield. So that is one of the concerns that is starting to bubble up to the top. And then you've got basically yield curve inversions. I talk about them so often. Anybody who asks me questions is like, oh my God, when is she going to come off this yield curve inversion thing? I'm not going to until it goes away, right? But you've got these curve inversions that are warning, usually what they warn is that you've got some kind of financial stress that's coming. Well, we saw some financial stress in March, but they usually also warn that there could be a credit deterioration coming. And that we haven't really seen yet. So this growth in credit card spending, this growth in leverage on the consumer does open up the possibility and increase the risk that credit deterioration would hit a little bit harder.